Hello everybody, in this video I will explain how to calculate a mortgage. This is based on my personal experience, trying to understand a mortgage. To calculate a mortgage, you need 4 factors: the loan, your monthly income, the interest rate, and the mortgage length. Let's begin with the monthly payment. If you want to find the monthly payment, you have to use this equation. It is not a simple equation, but let's try to simplify it. As you can see, with P we indicate the loan, the principal, with I we indicate the interest rate factor, and with N we indicate the timing factor. M is the monthly payment we want to calculate, P is the principal amount, I is the interest quote. The interest quote is equal to the interest rate, divided by 12 month. The most used mortgages are monthly payment mortgages. If you want a mortgage to be paid every 6 months, for example, you have to divide the interest rate by 2, as in a year, you pay 2 times. The total number of payments is equal to the mortgage length multiplied by 12 month. If you pay every 6 month, then it should be multiplied by 2, as you pay 2 times in a year. So, if we use some numbers, we can calculate a monthly payment. If we need a $100,000 loan, and we have a 3% interest rate, with a mortgage length of 20 years. And if we put these numbers in our equation, we get a monthly payment of $555. This value includes the monthly principal we are giving back to the bank, and the monthly interest quote. This is the mortgage payment profile. As you can see, we have a constant monthly payment of $555. At the beginning we have about $305 of monthly principal, and about $250 of interests. From month to month, your residual debt lowers, and the interest quote lowers accordingly. So for example, the first monthly payment is composed as we said. On month 12, the interest quote lowers to about $242, and the principal quote increases to $313, to keep the monthly payment constant. On month 120, or in other words, after 10 years, the interest quote decreases to about $145, while the principal quote rises to about $410. Near the end of our mortgage, after more than 19 years, on month 230, the interest quote is about $15 high, and the principal is about $540 high. Here we can understand why the interest quotes have that profile. Every month, the interest quote is calculated on the residual debt, divided by 12 month. So, on month 1, $250 of interests are calculated this way. 3% of interest applied on $100,000 debt, is equal to $3,000, dividing by 12 month, we get $250. On month 2, the residual debt is $99,695 high, 3% of interest supplied on that, gives the monthly interest of $249. If we go to month 120, after 10 years, the residual debt is $57,845 high, so that monthly interest quote is $145 high. To keep the monthly payment constant, every month, the sum of the interest quote with the principal quote should be equal to $555. Please consider that, we are using a fixed interest rate, always constant to 3% in this example. In a minute I will show you an example with the variable interest rate. So, we calculated out monthly payment by using this equation. If we want to calculate the loan we can ask to the bank, based on our monthly income, we have to first define the monthly quote we can afford. The monthly quote to be used for the mortgage in a safe scenario, should be about 1/3 of your net monthly income. You can decide for a higher monthly payment, to pay back faster the loan, but you have to pay attention that you have enough money for other important needs. Not every bank accepts a higher monthly payment, and for sure, going beyond 50% of your net monthly income, is not accepted or can be very risky. You should always have a safety margin, and if you save money, you could give back to the bank an extra quote to reduce your debt and the interests. If we consider a net monthly income of about $6,000, the monthly mortgage payment should be about $2,000 high. To calculate the loan you can ask to the bank, we have to use this equation. With these numbers, we get a principal amount of about $360,000 the bank will lend you for your mortgage. Some states could set a limit to the mortgage amount. Some states set, for example, about $600,000 as the highest possible amount to get. Even the bank could decide to set some limits. Anyway, this is an example on how to calculate the amount. So, let's now go back to the previous example, but applying a variable interest rate. The variable interest rate is a rate that could change from year to year, based on the national and international economic scenario. Generally speaking, if economy is good, the rate rises. If economy is bad, the rate decreases. The variable interest rate is more risky as the monthly payment could rise a lot, but the variable interest with a good strategy is the best to save money. In this example, we start with a monthly payment of $555. In the first 3 years, the rate decreases and we save money. After 3 years, a typical monthly amount is about $450 high. This means we are saving about $100 a month. Then the rate could rise again, reaching, for example, after 12 years the highest level, where we pay a monthly amount of $650. Here we lose $100 a month. In the next years the rate decreases again, and we save money. As you can see, the interest rate starts with 3%, for example, it goes to 1.5%, then to 5.4%, and then to 0.9%. If we calculate from month to month the interest quote based on the residual debt, we get the variable interest and the variable total amount. A strategy to save money is to start with a low and decreasing rate. In that years you save money, then, with the saved money, you reduce the residual debt with an extra payment to the bank. This way, you reduce the residual debt, and you avoid that in future an increasing rate could lead to a money loss. You can watch another tutorial on interest rate types we prepared in this channel to get more information. So, to recap, with these equations you can calculate the most important factors of a mortgage. The more you are prepared, the more possibility you have to get the best possible mortgage, and you can save a lot of money. Thank you very for watching Simple Money Tips. We are working on other business examples. If you have questions, write them down here. If you want, leave a like or subscribe to this channel. Thank you very much.